morning, everybody, and welcome to the Daily Energy Markets podcast. It is February the 7th, and we have Brent crude oil trading in Asia this morning a little bit higher, but still under $75 a barrel on Brent, and looking like the third or fourth week in a row now that we're seeing oil prices drop through the week. Despite what you'd have to say, it's hard to remember in the few decades that I've been a frontline journalist and engaged in the energy markets that we've had quite a substantial waterfall of unprecedented announcements and radical policy shifts from the US government that one would think in any other time would be hugely impactful on the markets. But it's a strange reality we're living in where it would appear that the markets are unfazed while the rest of us are feeling a bit like having gone 10 rounds with Muhammad Ali, and yet nothing is moving too much in the markets. Oil down, but equity still upwardly moving. Let's go to the US because, of course, there's only one person who has the explanation for all of that. Brian Pieri, founder of Energy Rogue. Brian, let's kick off this morning with some understanding of where US oil production is going to go. I'm reading increasing headlines that drill, baby, drill is now a mirage in the desert.
Yeah, and Sean, thank you so much. Thanks for having me. And as you accurately articulated, the wave of geopolitics impacts and policy changes that have come about because of the Trump presidency. There are a lot of initiatives that have been announced, and part of this is what I believe to be a political strategy of submitting 15 things for everybody to focus on while he's really setting the stage to maybe get 5 of them through. So there's kind of a flood of a bunch of different policies that are thrust at the market. You have tariffs, you have sanctions, you have a discussion of Gaza, which I quite honestly still baffled by that whole narrative. But when we talk about crude oil, let's talk about the fundamentals. The fundamentals are most of the growth in the United States over the last several years has been driven by the Permian. And that was driven by a lot of independents that were single basin owner operators. And they increased their operations in the Permian. What has happened over the last couple of years is a concentration or consolidation into larger entities. And with that consolidation, I see a slowing of development. It's going to be slower, methodical, but we are going to see kind of a constant growth. So instead of a rapid growth that we saw from 2022 to 2023, we're going to see a much more solid, stable growth, maybe 5-10% a year, something like that. We're sitting around 13.5 million barrels a day. And with the current rigs and current profile, I see maybe having a very similar arc for 2025 unless we see rigs change. In 2024, we went from 13.2 million barrels a day to 13.5. So not that much. I mean, 300,000 barrels a day is significant. However, it's not the previous adding a million barrels a day. So I see a continued steady march up. Some of the other basins are showing activity, but the fact of the matter is with crude oil starting off the year down, that's going to dissuade a lot of rigs coming back to the table. So I see 2025 starting off with the same lens as 2024. We're just going to be treading water, maybe growing a little bit. So hopefully that helps.
Patrick Coulson, CEO of Insights Global, welcome. Nice to have you with us. I wanted to get your thoughts again on the similar question, trying to understand why the energy markets in particular are not in any way fazed by what seems to be some significant geopolitical decisions, but also even the tariffs, the idea that we're going to go into a global trade war, and yet oil prices seem to be uninterested. Your thoughts on what appears to be a disconnect, the energy markets to the major headlines this week?
Yes, well, first of all, thanks for having me here. I guess most of the people are sort of confused about what's going on. So one day you hear this, then the other day, for instance, the tariffs on Mexico and Canada.
I mean, that seems like 5 years ago, and it was only 5 days ago.
Correct, correct. So it's going from left to right, and nobody's really sort of thinking, okay, do we need to take this serious or not? So I think a lot of people are just sort of waiting on the sideline and hoping this is just a bad dream, I guess.
The Robin Mills, CEO, Kamar Energy. Welcome, Robin. If you're OPEC Plus and looking at all of this and trying to keep your eyes focused on the fundamentals here, is this a year when OPEC Plus can go ahead with its plans to increase supply from the second quarter, which is a few weeks away now?
Yes, Sean. So I've just spoken to a bunch of investors who were very interested in exactly this question, of course, coming from the US and bringing the US view, but they wanted to know what the Gulf is going to do. Look, and I had to tell them, look, I think there's all kind of weirdness going on, as we've been saying, and who can rule out the really unexpected. But that aside, I think, we're in for another fairly soft year, and I think OPEC again will struggle to increase production in a meaningful way. Assuming it's not willing to accept the risk of prices going much lower. So, I think there'll definitely be an effort by OPEC to bring back some production, but I think OPEC has shown it will be very cautious and very measured in doing that.
Will that open up again, Robin? Your thoughts? I mean, will we get into an equation where we still have all of the major agencies, IEA, OPEC, and so forth, forecasting a 1+ million barrel a day demand growth this year? Is that going to be swallowed by other actors rather than OPEC Plus?
Well, I think the supply side is a bit more constructive than last year, because of this likely the slowdown in US growth, but there's a lot of incremental growth coming out of various places in the Americas in particular, and that adds up to something. And the demand side, well, again, we've still got that divergence of demand views, not as wide as last year, but still a divergence between OPEC and IEA, really with everybody else in the middle, but generally towards the lower end. But again, I struggle to see why demand is kind of meaningfully stronger than last year, with China, if anything, even slowing down further.
Brian, just trying to get behind all of the noisy headlines, and as we say, things that are being actually done, and there's apparently and quite significantly in the US in terms of policy changes that the executive orders are able to do, from the point of view of kicking down the doors of schools where there might be illegal immigrant children. But ultimately, where is the rubber meeting the road in the specifics of what wasn't existing a few weeks ago for oil and gas and energy companies and now does? What regulations have been removed or are about to be removed? And will they not be enticing for oil and gas companies to sort of take advantage of? So what exactly is the change on the ground that has happened or will happen? And will they not be attractive to the oil and gas companies to sort of unleash and open their wallets?
So that's actually a great question, and that gets to the root of the matter. And that's one of the things that sometimes people miss, which is, well, what does this really mean? There's a narrative, there's a drill baby drill. What does that actually mean? And one of the things, I'm actually down in Houston right now. There's a conference called the North American Project Expo. It's where all the producers in the United States talk about their projects, try and get financing, and financing tries to find projects. So it's kind of a good matchmaking for independent producers in the United States looking for financing and projects. And one of the narratives that I've seen is number one, you're going to see some of the larger entities cast off some of the smaller prospects that they have for development. Number two, anything that's up for sale right now seems to be mispriced to the higher side, meaning there's a lot of optimism as far as pricing, as far as policy. But the fact of the matter is, from the policy perspective, from my view, is that I don't see any meat around what is actually being presented. Most of the drill baby drill from 2016, most of those policies, which we talked about it before, Sean, were they were focused on areas that actually had nothing to do with production gains, and it had to do with opening up Alaska. Guess what? We didn't do that much in Alaska. It was driven in the Permian. So most of the regulations, I haven't seen concrete policy changes that actually substantially push it forward. There is an industry-wide on the supply side optimism because of the policy being more friendly. One of the key areas that I do see change happening is in the Inflation Reduction Act, which included some policy around methane emissions. And those policies would have potentially shut in 40% of the United States production because it's older production, it's more leaky, it has some methane, and some of those penalties were so steep that it could have knocked off 40%. That they started walking that back during the end of Biden's term, and as it goes into Trump, I think it is a law. So there, I mean, one of the things that's very difficult is that is a law. So they will have to walk that back in a very methodical way, and
Which is
that's
the interesting thing, isn't it? I mean, even if there is a new government, obviously there are laws on the books,
right.
and yeah, the government may choose not to enforce them. You're not going to get arrested for jaywalking under this government, but it's still against the law to jaywalk. Are oil and gas companies going to jaywalk, or are they going to obviously abide by the law?
Well, let's put it this way. Many of the penalties and Inflation Reduction Act, what's unique about energy policy and some of these laws and some of these things? I've been in and around the trading side of the industry, and when Dodd-Frank came out, after the financial crisis, when I remember I was at a trading company and we had an attorney come in and interpret the law, even though it was intended for financial securities, it actually had spillover effect into derivative commodities such as crude oil and natural gas. And effectively, the lawyer said they're still writing the law, but it's going to be retroactively enforced to last April. And we're like, okay, well, what rules do we have to play by today? So it gets very tricky when it gets to that. And one of the things is the Inflation Reduction Act is in place and those penalties are in place. However, they aren't enforcing. It is like your example on jaywalking. And I see with the change in administration that they're just going to let people keep walking across the street until they figure out some policy way to walk that back out of the law or amend the law. So that's my take.
Patrick, I wanted to get your insights of where the storage business is at the moment, where storage levels are at. And we've had a little bit of in recent weeks data indicating building of storage in the US. Generally, where are storage rates at? Where's the demand on storage? Do we see flows going into storage as we start a year where weaker demand, or we say weak demand, or global demand growth is predicted to be quite low? It was lowish last year. Where is the industry of tank storage and the appetite for more?
Yeah, good question. So if you look at storage rates, they're around average. So there is especially in Europe, for instance, there is less activity in the chemical markets. So that's being subdued. Actually, there's more interest. So a lot of these storage companies, they had this policy a couple of years ago to sort of divest in oil and fossil fuels. They're starting to, realize that their forecast of the energy transition were a bit, how do you say, too optimistic or maybe too fast. So they're refocusing and looking at their current business and trying to sort of sustain that
So what, they
because
had actually converted some storage tanks to take cleaner products, or
Well, yes, but they also sold terminals that were mainly aimed at fossil fuels. Obviously, they did not sell everything, but now they're realizing, okay, this is not going to take off as fast as we thought it was. So they're being much more cautious on sort of conserving their current business, also in the fossil fuel sector instead of going ahead in, for instance, hydrogen or I don't know, SAF or something like that. So also in the fuel business, actually, since let's say, especially in Europe, since the war in Ukraine, the real money makers have been fossil fuel tanks, not renewables or something like that, or chemicals.
Robin,
So
the
yeah.
Robin, the other big story this week, again in the kind of massive headlines that came through, was the announcement that the new U.S. government was reinforcing, or I think there was an executive order or some kind of reapplication of the maximum pressure campaign on Iran. I wanted to get your thoughts on that. Again, that didn't seem to do much for the oil markets. I mean, even if it was to work as it did in the past, you could see 1 million+ barrels of Iranian crude off the market. Your thoughts on the announcement, the lack of impact on the markets, on the price architecture, and what's the likelihood that it will be as successful, quote unquote, from an American point of view as it was last time?
Yeah, so the announcement itself is vague, and look, I think the industry pretty much expected that this maximum pressure would be reimposed. That's been the talking point for months and months anyway. Um, we've only just seen one new sanction, which was just announced, I think, yesterday on Sapere Energy, which is described as a front company for the Revolutionary Guards. I suspect that's a Biden era designation that didn't get actioned and has now just been picked up to be put to work. Yeah, look, this chasing this front companies is an endless job, of course. So that's the only kind of real tangible action. But clearly, the Trump administration is going to go after Iranian exports. I mean, I think we're seeing moves now on trying to reduce the um, Iranian power and gas exports to Iraq and to target those. Now, that doesn't affect the oil market directly, obviously, but another part of the maximum pressure. I think the Trump administration will find it much harder than they did the first time. Firstly, maximum pressure last time, a lot of it coincided with the COVID years, and demand was way down anyway, and China didn't really need the Iranian oil. Um, I think it'd be hard to squeeze China this time because you can't squeeze China on every front. You can't squeeze them on Iranian oil and on trade and tariffs, and on intellectual property and TikTok and everything else that the US is going after China for. They're going to have to pick their battles. Otherwise, China will just go ahead and do its own thing. Also, the Iranians have got much better at sanctions evasion than they were 5 years ago, and have much more methods for moving their oil to market.
Well, I suppose that is the point as well. I mean, when you think about the squeeze on China and never mind Mexico and Canada and so forth, but the outcome of that, one would think, is just more difficult to grow economies, more difficult to attract investment, and not only in the context of the China, but Brian, also in the US, which is at the point of becoming a major global LNG exporter. What impact are these policies likely to have on investment dollars into hard infrastructure that's related to the export of energy from America?
Well, that's actually a great question because I would say if you rolled back the clock 2 years, the entire globe was looking at this rapid expansion of natural gas in the United States as a good exporting resource that is continuing to grow. In 2025, we're set to add another 20% to our LNG exports. And if you look at the natural gas that is exported out of the United States, it's over 25% of our gas supply. So when you look at that and you have a US molecule that is worth, say, $3, $3.50, something like that, and in Europe it's worth 14, in Japan, Korea, it's worth 14, 14, 15, something like that, you can start to see the economies stack up. So the economics are there to continue that LNG expansion. But between the LNG pause that the Biden administration went under, now the tariffs on Canadian imports that still impact, well, at least deferred, but discussion points for Canada imports for energy as well as Mexico, you have this dichotomy of a myriad of issues dating back to the LNG pause. Now China is sanctioning any U.S. LNG to China, well, U.S. LNG and coal. And now that makes the scenario a little bit more of an unpredictable trade partner. And to me, that casts more doubt with some of these LNG projects, which take 3, 5, 10 years to build. I mean, some of these facilities are massive, such as the one in Canada, Kitimat, which is going to be coming on this year as well. So North America as a whole is going to be adding probably 6 to 7 BCF a day, or a significant portion to the global LNG market. And now the U.S. has cast doubt on the long-term viability as a long-term counterparty in that, because are we going to face tariffs? Are we going to face, like, it's a little bit more unpredictable. And these LNG contracts, I mean, these are multi-year, 5, 10, 20-year deals. So I think it casts a lot of doubt on any project that has not achieved FID.
And it's also a competitive place. I mean, Qatar's in the middle of ramping up its own capacity quite significantly. Let's go to the survey question today, which is a little bit focused on the OPEC point brought up earlier, which is OPEC Plus will need to keep all oil supply cuts in place through to the end of the year to see Brent crude average above $70 in 2025. There is current policy within OPEC Plus that has been postponed now, I think 2 or 3 times, to start to bring back 2.2 million barrels of oil a day. They didn't follow through with those policy decisions in the second half of last year. Now the next trigger date is April 1st. The question is, can they go ahead with these increases and keep prices above 70, or will they need to keep all cuts in place through to the end of the year to see Brent crude average above 70? Now we're well above 70 at the moment, so this is somewhat of a bearish question. Nonetheless, welcome the views there. Patrick, just looking again as to your point on the tank storage, the opportunities in fossil fuel and storage, we're seeing in the UAE the opening recently of a 42 million barrel a day, if not barrel a day, 42 million crude oil storage caverns in the mountains of Fujairah, which were built over the last number of years, a significant increase in crude oil storage capacity. Where are the places where you see this opportunity that maybe was given up in the past because of the transition? Is there obvious places where that could resurface, where there makes sense, where there's better opportunities than others?
So if you go sort of from west to east, I think the US is still okay, because of favorable policies and the emphasis that the new Trump administration puts on oil. So I would say that there still the market is pretty healthy. In Europe, well, it's like, they say one thing, but the reality is something different, right? So they're trying to limit their greenhouse gas emissions, but in reality, we need oil, we need gas.
We need
So
coal, it would appear in Germany, a lot of coal.
yes, this is a problem for investors.
I mean, there is talk, I know, advocating in Europe, the European Association for Tank Industry, to increase, because of the geopolitical energy security tensions, that the IEA 90-day mark for member countries to maintain 90 days of imports is no longer adequate, and they're arguing that should be raised. Has that any legs? Could that drive tank storage in the Europe?
Yeah, well, yes and no. So I've sort of participated in that study, and the conclusion is, well, yes, it would be better to have more strategic storage in place here in Europe. But talking to the Commission, I think a couple of weeks ago, I think yeah, it might take a while for that to be implemented, and they're more focusing on gas, as I understood from them, which is, I think, good, because the oil infrastructure in Europe is pretty good. I don't see a big risk in shortages or something like that in Europe for oil products. But gas is a problem, as Brian already said. We're having here very high gas prices due to the cutoff of the Ukrainian pipeline to Europe of Russian gas, which is, I don't know, maybe 5% of total demand, which is gone. And it's also cold, huh? So look at me, I'm having a sweater. Last year and the year before, it was a mild winter. But
yeah,
now
Europe kind of got
colder.
away with it a little bit the last few years.
Correct. Yeah. So, but now the weather is unpredictable. So high gas prices.
Yeah, and you would imagine over the sort of medium term, it's hard to see how Europe can sustain a competitive position in the world with such a differential between US and European gas prices. It seems
yes, but
turning back to Germany.
Yeah, for from that point of view, they're talking about a nuclear, and having more LNG supply would be a very welcome circumstance. So drill, baby, drill, yes, please.
Or going back to Russian pipelines reopening, if indeed there is a deal done with in the Ukraine, which is an unknown, but it's hard to see why Europe wouldn't do that. I mean, Germany, we've had world wars in Europe and gone back to loving each other, so that would seem not to be too difficult. Robin, I wanted finally to get your thoughts on the oil markets at the moment. We saw last year generally that the traumas in the Middle East did not drive too much of a geopolitical risk premium in the oil price. Occasional spikes when some events would heat up and then soften again. Your thoughts at the moment? Is the oil market underestimating the continued risk in the Middle East? We've got ceasefires in Gaza, ceasefires in Lebanon, but we have the U.S. president and now the news today that the Israeli defense minister has instructed his army to start to plan for the removal of Palestinians from Gaza. There's a very strong likelihood that policy, with the U.S. president's support, could come to fruition. Is the oil markets underestimating the kind of potential risks that all of this could trigger in the region?
Look, that situation is clearly not over. Clearly the war in Gaza and around Palestine in general is very much not over and not settled. But I think this is always the problem for last year and this year too. This is always a kind of relatively low probability, high impact event that actually affects oil markets. And I think, with Iran having been greatly weakened last year, the risk this year is on the whole is lower. Now, when you get local disruptions like the campaign in the Red Sea, against shipping and so on, quite likely. but something that really affects the global oil market now, I think that's become significantly less likely now. I think also China is a restraining hand on that and on the Iranians. Now, exception will be depending where the maximum pressure campaign goes, and does Iran at some point to make a decision to advance its nuclear program and even go for weapons. And if they do, there'll undoubtedly be a US and Israeli response. But even in that case, would Iran be in a position to strike at oil installations in a serious way? That's can never be ruled out, but I think the risk of that has diminished quite a bit since last year.
Yeah, it'll be an interesting few weeks ahead because, as you say, there's still a lot of tensions in the region, and the noise of the recent days would seem to indicate that there's more to come, unfortunately. So agree in this room at least that OPEC will have to maintain its cuts through the year if they want Brent above 70 on the average. They've got it so far this year. Let's see where things go, but it gives some indication as to the decision that they have to make in coming weeks about the plans to raise supply from April 1st. That would seem possibly not supported by market demand at the moment. Brian Pieri, thank you so much. I know it's late there in Colorado, but the good news is that you get to wake up in Colorado and look at those beautiful Rocky Mountains, even if you're going to bed late. Always jealous of that. Patrick, thank you so much. Great to have you. And Robin, as always, the best in the business. Thank you so much for joining us this morning. Robin Mills, CEO of Cameron Energy. All the best, guys. Have a great weekend. Bye-bye.
Thanks so much.
Same to you. Bye-bye.